we know that in part what led to the rise of interest rates in the developed markets was mostly inflation. If you even look at the inflation in country, it's now starting to come down. I think we've gone to as high as 10.4. It's down now to under 3%. The US and Europe still looks a bit sticky. Would you guide us in terms of what does that mean in our context? So if our inflation is coming down, the inflation on the other side is not yet coming down, where is the balance for us? How will that affect the domestic market?
Yeah, so if you look at inflation, the chart behind there is World Economic Report outlook. And really, 10% interest rates in the US were not something that we've seen in our generation. Maybe a few people have seen, but not mine.
David Howley.
So yeah, but the projections see developed world inflation averaging around 4-5%. That does not even compare to where we see ours. If you look at Ugandan inflation averaging about 5%, which is a central bank target, then you're going to have some policy divergence, which could sort of counter the benefit for the local currency, and we could see some depreciation here. But the expectation is that inflation in the developed markets will remain, the word that they're using is sticky. So remain sticky around the 4.5% level. This is against a 2% target that they're talking about. Now, if you talk to any economists or market participants that have been in the markets for much longer, they will tell you that 2% is unrealistic from a target level, right? So what next? We're going to get used to a period where we're seeing 3.5% from an inflation print in these markets. And that does not necessarily mean a negative thing for emerging markets. It simply means an adjustment to the way we do business. If I'm funding in foreign currency, if I'm borrowing for business purposes or development, and I'm looking at inflation at 3.5%, it means my cost of borrowing is not going to be anywhere close to when inflation was at 0%. So again, consideration for where interest rates on your credit needs will need to be plugged into your business planning purposes. So I think for me, that's the dynamic that we're going to see. Locally, inflation is coming down. We're at 2.7% as at last month. We are likely to go and touch 1.5%, but this is really on a comparison level because prices year on year compared to previous periods where we saw pretty much elevated food prices. So I think there is scope for the local rates to come lower, but I think the central bank will be a bit cautious given what's happening in the developed markets. I think probably into second half or first half into second half of next year, we see a lot more policy rate reductions. CBR at 9% or 9.5% possibly goes down to 8%. That could be a benefit if you're borrowing in local currency because your price of credit will come lower. But I think it's just that delicate balance from the central banks around the unintended consequences of policy adjustment if the global conditions have not really improved.
I quite like that, David, but I want maybe Philip, because if you say that as the dollar rates continue to go up, the cost of borrowing starts to go up. Over the last 18 years or so, we've traditionally thought that it's cheaper to borrow in foreign currency because typically you'd look at your 0% or 1% on dollar and then add inflation or any expected foreign exchange currency moves, and then you'd feel that, relatively speaking, it's cheaper to borrow in dollars. Does this benefit still exist, Phil?
Thanks, Daisy. I think there's been a shift, and that's what we need to recognize. We came from, I think, between 2008 up to the global financial crisis in 2013, the risk-free rate in the States, which is the benchmark on the back of which all of us start to derive our prices in dollars, was 0.25. Now, obviously, that world has shifted drastically. We're seeing levels of, 5.25, potentially 5.5 before the end of the year. Now, if you think about it in real terms, when you come to the bank to ask for working capital facility or a loan facility, we will start at 5.5, adjust for liquidity, adjust for your credit risk, and we could land anywhere between 7.5 or 12, depending on a number of factors: size, tenor, liquidity, etc., etc. So you're moving from probably a low 5.5 in terms of what dollar financing used to cost to a 10% in real terms. That's good. It's technically double the cost of financing in the new world. Now, given the context that David has shared around the likelihood that interest rates in the Western world will remain elevated for longer, given the fact that inflation is sticky, the implication could be that if you're thinking about financing in foreign currency, be it euro or United States dollars, you want to think about what the timing for that could look like. The view in the market right now is we could see maybe another hike by the Fed, and then a hold and maybe until June, and then a potential reassessment of whether or not the Fed should start to cut interest rates. But we also think that the world where the Fed was pricing interest rates at 0.25 is gone, and it'll be gone for a while. That has a couple of implications from a business perspective. Number one is, and we saw this in the past, where clients who had UGX receivables were still borrowing dollars because UGX on a comparative basis, normally speaking, was more expensive. In the world where interest rates are almost at 10% when you come to the bank to borrow, that might change. And so strong consideration needs to be made as to if a business has dollar receivables or euro receivables, then they should could consider borrowing in that currency. But to the extent that your predominant business cash flows are UGX denominated, then that might not particularly make a lot of sense. That's number one. Number two is in terms of timing. Obviously, policy decisions are not static. And we might get to a point where we start to see the Western world, either ECB or Bank of England or the Fed, US Fed, starting to cut interest rates. So then the conversation becomes, if you are going to engage in a large capex project, is now the time to borrow? And at these rates at which you should borrow, or do you have a bit of time to consider when you want to make that capex decision? So timing is another consideration. The other one, which is probably going to take up a huge part of the conversation this morning, is risk management. I think if the last, and as Alan spoke in his introductory remarks, if the last 3 years have taught us anything, they've taught us that a lot of things that we do not expect to happen will eventually happen. And so there's a place for anybody who is looking at financing or really managing their business to look at risk mitigation strategies. At some point in time, I used to speak to the clients at Akaba, and I used to tell them about, fixing interest rates. And they were telling me, look, interest rates are close to zero. Why would I hedge? Well, interest rates are now 5. Those who hedged have smiled all the way to the bank. Those who haven't hedged have literally seen almost a double of the cost of financing. So risk management, active risk management, should be a part of any business strategy, in as far as the future is concerned, and as far as interest rates are concerned, both in local currency and in foreign currency.
So if I hear you correctly, you're highlighting that it's no longer as cheap as it was before to borrow in foreign currency as opposed to borrowing in local currency.
Yeah, it's not.
And you're saying that some of the factors that are playing in there are because the dollar rates have gone up, but also the outlook on exchange rate does have a part to play.
Actually, on that point on outlook on exchange rate is something we need to look at as well. Mm-hmm. So you could argue that if I come to the bank and borrow X amount of money for 3 years or 5 years, mm-hmm. I will still borrow at, let's say, 11%, as opposed to maybe 15% if I borrow in UGX. Mm. But the way to think about it is that, especially in a world where, or if your business has UGX as a predominant cash flow, what you're doing is you're exposing yourself to the volatility of the currency, because on a regular basis, as you need to buy the foreign currency to meet your debt obligations, you're exposed to the spot foreign exchange rate. Mm-hmm. So you've introduced two variables: interest rate risk plus currency risk. So I think a more strategic or a more prudent approach would be to try to match your liabilities to your assets, which would mean that the currency in which you borrow should have a natural, you should have a natural flow of that currency. Or else then you introduce another component of risk to your business, which can also be managed from a risk management perspective, but it just introduces complexity into what would otherwise not be a very complex scenario.
Or operations, is not FX trading. Your core operations is not the managing of FX risk. You have businesses which you run, which you want to concentrate on. The managing of FX just happens to be a byproduct of your business. So before I go into the presentation and before I go into solutions, I want to maybe talk about two concepts. One is hedging, and the other is speculation. So often, when you talk about hedging, you get asked questions around, are you speculating? My answer is no. It's two completely different concepts. Hedging is putting in place risk management solutions to ensure the viability of your business, to ensure your business continues to be a going concern. Speculation is taking a view on the market with the hope of, you hear words like winning, beating the market, gains. That's not your core business. It's great when it works out for you. It's not so great when the currency moves from 3850 to 3580 and you're sitting there thinking, okay, I could have locked in these rates. Now, what we should be talking around here is hedging. What does hedging give you? Hedging gives you certainty. Hedging allows you to go to bed at night knowing that your business is going to be viable for the foreseeable future. And what do I mean by that? Very simply, at the start of each financial year, you all put in place forecasts and budgets, whether it's on a monthly basis, on a quarterly basis, on a semi-annual basis, on an annual basis. You have some level where you want to be able to sell FX. Beyond that level, your business no longer becomes viable. What we look to provide the solutions should allow you to be able to lock in a rate which is better than your forecasted rate. Now, if you lock in a rate that's better than your forecasted rate, so let's, for example, say you lock in 3,800 for 3 months. If in 3 months' time, the rate is at 3,900, it's human nature. You're going to feel like you've lost. But then it's a mindset, you're back to speculation, which is not your core business. Remain on the side of hedging and risk management. The moment you go into speculation, you're not concentrating on what you should be doing. Your output, expansion, reducing cost, you're now concentrating on Forex. You're waking up on a daily basis and wondering, where's dollar UGX? Where is it going? Is it going up? Is it going down? That shouldn't be your headache. That should be our headache. Conversely, if you locked in 3,800, in 3 months' time, the market was still at 3,775, you feel like you've won. Again, even though you've won, it's the wrong mindset. That's not your core business. So bringing it back here, I just wanted to distinguish between speculation and hedging. Hedging is putting in place risk management solutions for the future viability of your business. Speculation is taking a view. That's not your business. As I go through the presentation, I'm going to be using 3 words frequently. One is participation, another is protection, and the third one is optionality. And very simply, anytime I mention these words, participation means you're able to sell your foreign currency at the market rate. Protection is the worst case rate that you're going to sell your foreign currency. Optionality, as the word suggests, is you have the option to sell at that price or you sell at the market price. I guess with most presentations, we tend to focus on the currencies that we see a lot of clients trading in, and across Africa that tends to be more dollars and euros. So again, this becomes a two-way conversation where we'll look to understand your pound exposure. We can go into market analysis around where we expect the pound to go. But if I give more a brief overview around the dollars, euros, and it will feed into the pounds. And it also feeds into the point, the question you had around the price. maybe let me just finish that one quickly around how we get to that forward price. So she's mentioned is the interest rate differential. A very simple way of looking at it is the spot rate today plus the forward points. How we get to the forward point is a factor of where the foreign currency interest rate is versus the local currency rate. As it gets more expensive to borrow one currency versus the other, the points will widen or contract. And that's why you'll find that the snapshot from today differs from the 6-month point of view. So now bringing it back to the different market views. So the US, during COVID, had quantitative easing. They pumped in $5 trillion into the economy. As of now, they've only taken out $1 trillion. That means the economy is still very liquid. There's still excess dollars. Contrast that with the UK, where housing prices are dipping, and the Eurozone, which is obviously struggled a lot from the Russia-Ukraine crisis, as has the UK to an extent post-Brexit and a lot of, well, the exodus of immigrant workers, right? The UK economy has not been the same since Brexit. So naturally, over that period, you'll see that the pound has weakened against the dollar. The euro has weakened against the dollar. A big factor is this quantitative easing that happened in the US. And that's why the dollar has naturally been stronger versus these two currencies. If you look at the amount of pain that those three economies took, the US took the least versus the UK and the euro. So in terms of the market view, do we expect the pound to get to as strong as it used to be against the dollar? It's very unlikely. The dollar is obviously now the more dominant, well, obviously it's not parity, but it's not at the rate of what it used to be before in terms of exchanging pound for dollars. But from your perspective, the expectation of the UK is they're still going to see some pain. I think for this year, the expectation is the Fed may or may not hike one more time. I think it's like a 25% probability. That was before last night. So last night, the ISM details came out. The ISM is the manufacturing data in the US. If it's below 50, it means the environment is expected to contract. If it's above 50, it's expected to expand. It was below 50, but it was better than expected, and it's trending higher. So the expectation now is the US actually may not need to hike one more time. Will the UK hike? There's still a possibility of one. Will the euro hike? The eurozone, there's still a possibility of one this year. So that's what factors into the pound depreciating at a quicker rate than the dollar. And similarly, that would mean against UGX, the pound will not strengthen as quickly as the dollar will strengthen against the UGX. But all these solutions that we're showing now for dollar UGX would apply in a very similar way to pound UGX. It would just be a different reference rate.